Welcome to the latest edition of Fundamentals. This time around, I'm going to look at an actively managed fund, namely River and Mercantile UK Equity Smaller Companies. The £850 million fund's mandate is to generate capital growth for advisors and clients. As its name suggests, it seeks to do so by investing in smaller companies. Fund manager Philip Rodrigues and team focus on making their picks from the smallest 10% of the UK stock market as measured by their market capitalisation. The fund comes with a very clearly defined investment process, which is underpinned by a quantitatively based proprietary system, which itself provides filters and screens to help the fund managers sift for suitable portfolio picks. In general, Rodrigues and team like to identify young, rapidly growing businesses that can deliver hefty share price advances. The portfolio is kept pretty tight. The latest fact sheet reveals it contains 71 holdings, although the top 10 represent barely a quarter of the assets. So the River and Mercantile team does look to provide diversification to manage the risks that can come, and do come, with smaller firms. The biggest positions in the fund as I sit here are premium drinks mixer provider Fevertree, drinks retailer Conviviality, smart metering systems, corporate telecoms and bandwidth provider Gamma, and language translation software provider SDL. By market cap, just over 20% of the assets are in mid caps, nearly 60% in small caps, and just over 20% in micro caps. There is no exposure at all to large caps such as the members of the FTSE 100. By sector, industrials, consumer discretionary and tech are the three biggest exposures at 26, 21 and 15% of the portfolio respectively. Intriguingly, just 8% of the assets are in mining stocks and barely 3% in oils, despite the huge number of junior diggers and drillers quoted in London. Any advisors or clients who are looking for defensive stodge might be disappointed as well, with a 0 weighting in utilities, 3% in telecom and just 4% in healthcare. The fund is eligible for SIPP, ISAs and dealing accounts, and the minimum investment is, I think, just one share. Now on this occasion, we're talking about the accumulation units, where the dividends are automatically reinvested, although River and Mercantile UK Equity Smaller Companies does also come with income units where dividends are paid out semi-annually. The ongoing charge figure is 0.83%, so advisors and clients do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. So, those are the mechanics of the fund. The question to address next is why could advisors and clients consider it for portfolio inclusion right now? And I think there are, well, 3 perfectly possible reasons. The first is that small caps are doing well in the UK. The FTSE AIM All Share Index has outperformed the large cap FTSE 100 and the mid cap FTSE 250 with an 18% gain so far this year against 2% and 8% respectively, while the FTSE small cap benchmark's up 10% in capital terms. Small caps can provide terrific share price gains when things go well and you find a few winners. Second, picking small caps can be rewarded, but it can be downright dangerous as well, and frankly advisors and clients haven't got the time. Smaller firms tend to be more reliant than big ones on a particular executive, a certain product or key geographic market, so they have a lesser margin for error if something goes wrong. In addition, they're not always as well funded as the big caps, so in a worst case, they can turn into a cash sink or go broke. A fund with 71 holdings therefore provides some welcome diversification and therefore some management of the downside risks. Finally, the fund and its managers have got an excellent long-term performance record to suggest that its screening process is proven. This chart shows how the fund has done since inception in 2006, although I should stress that Philip Rodrigues himself has not been there for all of that span. He joined from Investec in 2014. This is not to say River and Mercantile UK Equity Smaller Companies Fund will suit every advisor or client's needs, also for 3 reasons. First, those advisors and clients who are seeking income are unlikely to be excited by a 1% yield. Second, others might not like the 0.83% ongoing charge figure. There are only a handful of rival actively managed small caps that come cheaper, however, and the sole passive exchange traded fund is cheaper as well at 0.58%. But I've no doubt that the River and Mercantile team would argue they provided value for money, given their 5 and 10 year performance records in particular. Third, small caps are risky, things can and do go wrong. Small caps tend to outperform when markets are rising and animal spirits are high, but they can underperform and get hit hard when a bear market growls its way to view and the market starts to run scared. Advisors and clients therefore need to make sure that they can be patient, sit out any bear downturn, and not find that their personal circumstances mean they need the cash that's in the fund and are forced to sell it at a potentially inopportune time. Advisors and clients must therefore do their research on River and Mercantile UK equity smaller companies to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.